Hi there, thanks for joining our online event this evening. Today we're here at the Tauranga PMG Investor Roadshow and we're joined by economist from Infometrics, Brad Olsen. Tonight we're going to be covering off content from the commercial property market, the investment market and the economy, and of course the upcoming Pacific property capital raise. We hope you find this content insightful, enjoyable, educational, and we would encourage you to reach out with any questions, feedback or interest in the upcoming Pacific property raise and contact any member of the PMG team. Thank you and take care.
Well, firstly, welcome. Good afternoon, good evening. My name's Scott McKenzie. I'm the CEO of PMG Funds. It is my pleasure on behalf of the team, the loiterers at the back of the room there, the PMG staff, to extend a very warm welcome to you on what is a typical winter's day, I guess. Thanks for braving the elements. We were a bit concerned if this event was yesterday or the day before that we probably would have had half the crowd, but well done for coming out. Certainly a fantastic crowd coming along here today. We'll take that as if you want to come and listen to me and not Brad or Matt, but that's okay. So we do appreciate that. Certainly a few coughs and flus and COVID out there at the moment. We're seeing that around the traps. Our own team, probably 4 or 5 people down at the moment. And certainly around the country, if you look around, quite a bit of pressure on the system, with the hospitals, as we all know, under a bit of pressure at the moment. Schools having to shut periodically just to get through fundamentally, and certainly reach out and feel for some of our businesses who are having to close doors, particularly hospitality, to actually get things done, and with sicker staff from time to time. So there is a bit of that floating around. Good to see you're all fit and well and healthy though. Just out of interest in terms of a litmus test, those that have had COVID, monkeypox, the flu in the last little while, hands up. That's interesting. Not so many of you. A lot of you managed to dodge that. Those who've got COVID currently, hands up. Okay, so we've got a few in the room who haven't had COVID and they'd like to keep it that way, so we'll do our best to try and ensure you go away and enable that as well. We've got, ladies and gentlemen, with us Brad Olsen today, who's the Principal Economist and Director at Infometrics. Many of you will know his name. I'll give you an introduction to Brad shortly, so welcome Brad, thanks for taking the time. He's been talking to the TV earlier this afternoon and no doubt share some views as to what he's been sharing with 7 Sharp as well. We've also got Matt McCarty, who's our Head of Investor Relationships. Many of you will know that name. He's going to speak after Brad. We've got an offer coming to the market, upcoming offer, our flagship fund, Pacific Property Fund, raising some additional capital to acquire 3 high-quality industrial properties, one in Hamilton and 2 up in Whangarei. And so that'll take that fund to just over 470 million of aggregate value, and one of the largest unlisted real estate funds in New Zealand. And for us, it's not about bigger is better. It's more about quality and income resilience. And Matt will talk a bit about the importance of income resilience and stability of returns and what that means for you as investors, or could mean for you as investors if you are interested to come on board. So Matt will talk about how you can participate in that offer. I just want to first start by talking a wee bit about PMG, who we are, what we're about, for those that don't know us, and then I'll hand across to Brad. So we are one of the oldest licensed unlisted property funds managers in the country. Been around now for 30 years, it's actually our 30th year. And really since we've been going from day one, our core vision is to be principally the most trusted property funds manager in New Zealand. And ultimately what that means is never taking for granted the trust that our customers place in us day in, day out, whether you are a tenant, a business or an occupier occupying space or high quality space that we provide to get on and do commerce and ultimately contribute to New Zealand's GDP, or whether you're an investor, passing over what is your hard-earned capital to us to not only preserve that capital, but also to, through our in-house active funds management, property management team, to generate a regular and reliable return on that capital and hopefully grow the value of that capital over time. And when I say over time, I mean over an enduring period, which is really important in the theme for today. One of the challenges with looking out a bit, we're facing into some quite interesting times at the moment. We've got a few clouds, economic clouds on the horizon, and Brad's no doubt going to talk a bit about that as well. And so I want to put that in the context. If you think about the cold and flu season, the good news is we've got spring just around the corner, the sun's going to come up. And so we have this opportunity to look through the challenging month or two. They say this is the darkest hour before the dawn. Sort of feels like that a bit at the moment. But again, the sun will come up and we can look through that. You put that in an economic context. Certainly, we have got some darker clouds coming over the horizon. But the key to think about, particularly in the context of this evening and what we're going to talk to you about, is looking through those uncertain times, looking through some of the rhetoric from media, the fear that's currently out there in terms of our equity markets, and understanding that as long as you've got a good, clear, long-term strategy, then if you take that view, commercial real estate or your investment portfolio or strategy will look after you. And that's exactly what we've done as a business for the last 30 years, is taking a long-term view to investing in commercial real estate. And so if you take that view, it will look after you. One of the core purposes why we get out of bed every day is to help enable New Zealanders get access to commercial property. We know it's out of the reach for some, typically a larger ticket price. So for us to be able to facilitate investors, Kiwis, to be able to invest in commercial real estate really means a lot to us. And principally that's about enjoying the benefits that commercial real estate can provide around regular, reliable income and growth and value over time. And for us, if we can help chart pathways for New Zealanders towards financial freedom in some part through interacting with commercial real estate, then that's an absolute win for us, and that's principally what gets us out of bed. So as I mentioned, we've been around now for 3 decades. We've brought a number of investment offerings to our clients over the years. We have simplified our business to some degree. So we were a syndication business, so a lot of individual syndicated schemes, standalone building and tenant investment offerings. We've now rationalised that into a funds management structure. So quite simply, it's about spread of risk, not being exposed to any one particular building, geography, tenant, sector of the market. So if something goes bang in the night, we don't have an impact materially to returns to our clients. And that's where we want to be, a resilient, a robust investment vehicle that can withstand the test of time, particularly when we have ups and indeed downs in our market cycle. So we have 5 unlisted funds now with aggregate value around just over 900 million. Property from Invercargill through to Whangarei. And really for us, we have 3 offices around the country. So our global headquarters here. We have an office in Auckland and an office in Christchurch. And that's important to us to ensure that we have through our in-house team. We've made the call to ensure we have a team of property managers, facilities managers within our business, in contrast to some of our peers who use an outsourced type model, because we want our people to be close to our properties, close to our assets. And so they're invested in not only PMG, but also our funds as well. So they're principally, when they're looking after those properties, treating it like it's theirs, because quite literally they are owners as well. They wear the customer hat alongside yourselves. And we think that's a really good enduring model to ensure that we're doing the right thing by our properties and therefore yourselves as investors. So the journey over the last 30 years, 3 decades enduring through a number of recessions and ups and downs of the market. Each time losing a bit of skin and learning along the way. And I think that's important that we do take the time to learn from the tough times, because anyone can look good when the tide's coming in. It's principally when the tide goes out, you see who's wearing undies principally. So what I really value is sitting around a boardroom table with others, like-minded people, but particularly people with a bit of grey hair, people who have been through a few cycles and understand what it is to actually stick to the course, to set good strategy, not get too flustered about some of the short-term stuff that's happening, try to look forward through that and keep a focus on the light at the end of the tunnel. And so I find that immensely valuable to be sitting around the table with other grey hair or like-minded people. Unfortunately, I'm adding a little bit to the grey hair proportion within the boardroom now, but that's okay. That's just 3 children and 10 odd years in property management as well. 2016 we became licensed by the FMA, so we're regulated, we're looked over by the FMA and an independent supervisor. Principally what that means for yourselves as a essentially licensed manager is there should be a higher level of confidence in that we have someone overseeing us, so we've got accountability not to yourselves but also to a regulator. So it means we as a business need to be more organised. We have to have strong governance and policy and process in place to ensure that we're doing things the right way. Contrast that to some of our peers in the market who are what we call unregulated or wholesale offers. they have a lesser requirement for accountability. And so that's something just to think about when you're making investment decisions as to whether you want to go down the path of a licensed manager who has oversight or someone who doesn't. And there's very good wholesale managers in the market, don't get me wrong, but just some questions to ask around that in terms of obligations and accountability. Very pleased to have launched our sustainability report earlier this year. For us, that really means doing the right thing by our key people that we do business with. So, from an environmental perspective, the initiatives that we've been doing for some time, really we thought it was apt to actually put them on paper and say, this is what we're doing, here's some of our goals, here's some of our targets around what we think we and others, our peers, should be doing in the market to lift the bar around carbon emissions, environmental performance of our property, our buildings. Because the important thing is if we're doing the right thing by our buildings, we're doing the right things by not only our tenants or occupiers, but also the environment as well. I encourage you to have a look at the sustainability report. Equally, aside from the environmental initiatives that the team are working on, we also have a responsibility and feel we have a responsibility to the communities we operate in as well. We've been living for 30 years in the Tauranga community, and so it's important that we're also stepping up and giving back where we can. So with the launch of our charitable trust last year, our focus is very much, you recall earlier, around financial freedom and creating a journey towards financial freedom. So through our charitable trust, we've focused heavily around education and helping enable and educate young adults of tomorrow around financial literacy. So if we can help enable people to make better decisions, particularly our younger ones who may not have otherwise had an opportunity to make good decisions, think about money, how they spend money, how they invest money, how not to lose money or make bad decisions around money, the powers, as Einstein says, the power of compound returns, then that's got to be a good thing for them as individuals in charting their own pathway to financial freedom, but also for our wider community. And so we're quite passionate about that, and the team are doing a lot of work around that as well. The elephant in the room, clearly we're into an economic environment at the moment, which is most interesting. I find it fascinating as to what's happening out there at the moment, the influence of global push and pull factors, supply chain, labour constraints and the likes as well. So you'll be no stranger to the fact that inflation's kicking on at the moment. We see that when we fill up the car, we see that when we're shopping. I'm seeing it at the moment because I'm renovating and I'm seeing my builder send me invoices that otherwise weren't agreed. So it's certainly getting more expensive out there to do stuff. And that's just the nature of the environment we're living in at the moment. And so on the back of that, we've got central banks around the globe playing catch-up footy, lifting interest rates. In fact, Adrian's put the cash rate up 50 points again today. So we're on the way to increasing interest rates. And that's okay, we understand that. And you've got to put it in context as well. Most forecasters are talking about a 3.5% to 4.5% peak for OCR. In 2008, the OCR was 8.25%. So we've just got to understand we're coming from a fairly low base. Notwithstanding that, we are a property funds manager. One of our biggest overheads is interest and interest costs. So we need to be thinking about a strategy how to mitigate or manage that cost as well. So for some time, we've had a interest rate swap or a hedging program in place to help mitigate or reduce the impact of cost increases by way of interest rates to our portfolios. And also we've been thinking about how do we reduce risk. So we've been actively reducing the gearing, the borrowing levels of our funds for some time now, in anticipation of events like this where we see interest rates starting to creep up. So for us, it's about how do we manage and set ourselves up now well so we can endure through the challenging periods and become out a little bit stronger at the end of it. Certainly one of the challenges and biggest challenges you as investors have today, particularly if you're sitting on a bit of cash in the bank, is what you do with it. Up until about March 2020, you could achieve some sense of a positive real return with cash in the bank on term deposit, albeit of late the TD rates have been pretty poor. Now we adjust for inflation, and you can see the orange line there starting to push up. That's the inflation index. You're starting to walk backwards at a rapid rate of knots. So let's put it in context. You might have recently sold a house or sold an orchard. And so let's say through the house sale, you've got $500,000 sitting in the bank on an average term deposit rate. So with the inflation headline rate sitting around 7 to 7.5% at the moment, within 12 months, that 500,000 is now looking like, in real terms, 475,000. So the erosion of the purchasing power of that money really is starting to take effect. If you've sold your orchard, you're sitting on a bigger chunk of change. We've got $1 million in the bank. So the reality is, at the end of those 12 months, we're now sitting in real terms on $950,000 in the bank. So some real headaches for individuals who are sitting and trying to make investment decisions in a world like this. And that really comes down to, how do I think about my strategy as to hedge for inflation, or mitigate the impacts that inflation might have on my portfolio, on my savings. And so something to think about. The good news is, we believe certainly unlisted commercial property has got a part to play in that. Commercial property over the last 4 or 5 decades has proven time again that it indexes well, and in fact actually outperforms inflation. And so we see through the security of land, bricks and mortar, there is a real true defensive characteristic to be invested in commercial real estate, so something you should consider. Obviously with land, we're not making any more of it, thanks to our bureaucracy and red tape and laggard infrastructure. We're not putting more and more supplier land on anytime soon. And as we know, in the case of my house and renovation, costs are going up to construct. So new builds are costing more. And so we see the tide lifting all boats, including existing property stock over time. And that's why we have this inflation indexed or hedged effect with land, bricks and mortar. The good news is the real estate sector, particularly commercial real estate across industrial, office and commercial, or large format retail, is actually in quite a good space at the moment. Businesses have been through COVID, pandemic, they've actually got reasonably good balance sheets, and we've got quite low vacancy across the board. Industrial, less than 3% across the main metropolitan centres. Office, with the exclusion of 3 office towers in Auckland, we've got sub 10% vacancy, and certainly large format retail, negligible across the board in the main areas we're investing in. So we're coming from a strong base in the sense of where the industry is at the moment from a commercial property perspective. One thing it's quite unique for commercial real estate is rents typically are linked to inflation in some way. And so if you look at our portfolio, we have 1/3 of our portfolio with rents directly linked to CPI, to inflation. 1/3 are linked to fixed or structured reviews, and the other 1/3 to reset to market, essentially. And so that helps us maintain an income profile that's in line to some degree with the inflationary pressures that we face in front of us as well. One of the other unique characteristics of commercial real estate is ultimately, other than adjunct to other asset classes, despite whether values go up or down, commercial property typically provides a regular, reliable income stream. So we saw through 2008, we saw through 2020, values went up, values went down, but we saw the cash flow continue in a consistent manner. That's quite a unique characteristic of commercial real estate relative to other asset classes, and certainly a benefit that we believe works well for largely our client base. But the one thing I want to leave with you just to take away is to think about looking through the next couple of years, the stuff that Brad's probably going to tell you about shortly around some of the challenges that we're facing into, and think about, yes, there is light at the end of the horizon. And with commercial real estate, if we're taking that longer term view, we're putting the stuff in the bottom drawer, allowing people to get on and do what they do daily, then commercial real estate very much will look after you. And so that's the key message that I want to leave with you. So I'll pause there. Save for rapturous applause, and then I'll hand over to... no, that was serious, rapturous applause. Yeah. I wouldn't say rapturous, but anyway, we'll go from there. So I'll introduce you now to Brad. So Brad Olsen, I've got a bit of a bio note, so I'll make sure I get it right for you. Brad's a principal economist and director of Infometrics. He's one of New Zealand's leading economic commentators. You've obviously seen him on the telly and various media publications over recent years. Originally from Whangarei, now lives in Wellington, close to where he calls the action is. Quite well educated sort of a chap, Bachelor of Commerce, BA with majors in economics, public policy, international relations and political science. 2016, he was acknowledged as New Zealand's Queen's Young Leader of the Year. In fact, actually he's met with the Queen on 3 separate occasions, which could suggest that he's met with the Queen, that the Queen's met with Brad more than perhaps Prince Harry in recent years as well. In 2019, Brad was named as one of Asia New Zealand Foundation's 25 people to watch. In 2020, Young Wellingtonian of the Year, and he's one of New Zealand's youngest Justices of the Peace. And if you want to get married, he's also a civil union marriage celebrant. So we can sort you out later if anyone wants to get onto their second or third time round. So without further ado, ladies and gentlemen, I'll just so you can put your hands together, warm welcome to Brad Olsen.
Kia ora, thank you for that. It's always a good start to the introduction in terms of being volunteered for marrying people and similar. Kia ora and good evening. It is lovely to be here. And coming at quite a strange time for the economy. Those of you who were lucky enough to come in a little bit earlier walked into the back of a 7 sharp interview, so if you managed to make it home before 7 p.m, you can go and relive a few hours back from the comfort of your own television. But I think just to highlight, some of the challenges that Scott has outlined are real. We find ourselves in a very unique economic position. Inflation is a thing again. Now, as a young economist, we spent about 2 weeks on inflation at university, if that, and we were told very clearly that, look, that was an issue of the 70s and 80s and early 90s, but we've killed that, it's done. It's not. It's very much back. And I think, this is, the sort of position we find ourselves in now requires quite a different way of going about the economy and managing the various challenges than something that we've seen in recent times. So it does feel quite different. It feels, certainly for me, quite chaotic. Part of that's because this is week 7 on the road and I've been travelling out and about across the country. I've slept 5 nights in total in my own bed. But what that has highlighted is that for as much as there are complications and challenges out there, people are getting on with the job. They're quite keen to keep things moving. They know they've got that work that they can continue with. So as much as there are challenges, there are also very much opportunities. Despite that, it is going to be harder and more expensive to grow in 2022. Part of that realistically is just because everything's relative, right? Anything after the very heady levels of everyone spending more cash than they've ever seen at the start of 2021 is always going to feel a little bit more lackluster. Because we did very much, and trust me, talking to the real estate agents and similar, we saw a period of some of the highest levels of growth that we've seen in a generation. People were going out there and buying property, sight unseen. They were buying a boat, they were buying a caravan, they were buying the entire package all at once. Anything coming off that was going to feel difficult, which is what we're starting to see now. But again, there's that feeling where there's enough momentum behind us as an economy. New Zealand started 2022 with one of the best economic performances of any developed nation on earth. Importantly, we also started it with more people still alive than most other countries on earth as well. We've had a strong health response, we've had a strong economic response. Now, there is some difficulty. What we've done over the last few years to try and protect the New Zealand economy is drag 5 years worth of spending into 1.5 or so. That means that there's a little bit of a gap to make up, a little bit of a lull, if you will, coming through for the economy. But again, there's a feeling that there's some strength coming forward. Now, we could talk GDP all night, and you wouldn't understand anything I said, and I probably wouldn't understand anything I said, although I might forecast the next 12 of the next 3 actual recessions if we tried. But what I do want to highlight, and one of the easiest numbers that we always focus on as economists, is just pure spending. Because if I'm willing to get money out of my wallet, and you guys are willing to get money out of your wallet, there's obviously enough money in the wallet to go round. And so just to highlight, what you can see here is that despite those hits from the likes of level 4 lockdowns and similar, we have been able to get that economic momentum up and running. Kiwis out there have been spending a bit of cash. It's more difficult. There are huge challenges. There's big bits of inflation that are hitting us in the pocket, but we're still spending cash. And I think that's an important start. You'll also note the few spikes. I'll use this screen, sorry for those of you over on this side, but you can sort of see the great toilet paper wars 1 and 2 of the last few years of the pandemic, when we've started a panic buy and similar. But just to make the point that at the moment, despite you can see that short-term hit in 2022 from the Omicron outbreak, again, New Zealanders are still spending more cash now than what we did pre-pandemic, at a time when we have none of the 4 million tourists who normally would be in our country to spend their money. So again, momentum, it's taken a bit of a dive, but there's still enough in there and some big opportunities, I think, for people when they're looking out there. Now, despite that, despite people having enough current oomph, if you will, to keep the economy running, there are some very, very pessimistic views out there, probably led by us economists, to be fair. Like I said, we've forecasted most of the last few recessions that have and haven't come true. What to focus on here, though, is you do see, and this is alarming as an economist, trust me, because sentiment is huge. We know that people, humans, are behavioural creatures, and if they all start to move in a sudden direction, you get a bit of a groundswell on. Households at the moment are telling us that they are at their most downbeat on record. They think that the expectation for the economy over the next year is worse than the global financial crisis. Worse than the start of COVID-19, when we thought that the Great Depression 2.0 was upon us. In fact, according to one survey, it's worse than the Great Recession back in the early 1990s. Just to let that sit in, New Zealanders currently think it's worse going forward than at all of those times when things were actually quite bad. And that's, again, sends some huge alarm bells among economists. If households are saying they're not feeling too pretty, well, of course, they're going to spend less. But again, important to highlight two things. One, everything's relative. If you double interest rates, yep, no household's going to sit there and go, I'm feeling pretty good, because you're not feeling nearly as flush. You don't have the same amount of cash. What it also shows, though, is that people are in this darker mood. People are starting to turn around their expectations. But because of that, people are also going to be working a lot harder to try and be the people on the top and get those better outcomes as we move forward. Because with this, there are opportunities, but they are a lot harder to grasp. And I think the point that was made before around everyone looks good when it's a good time, it's when you sort of draw the tide out that you start to see who's wearing underwear or not. I will just confirm, not only am I wearing underwear, but I've also got my lucky dollar socks on tonight for the Reserve Bank's decision. So just to highlight, again, one, that I'm dressed in, two, that there is, those opportunities going forward. It's hard though, and it's hard, and I'm actually quite surprised that so many of you are here tonight, because we know that one of the major limitations for the economy at the moment is the labour force. And now we'll get into brain drain and similar in a second, but at the moment there are still well over 100,000 New Zealanders each and every day who are having to isolate at home, either with COVID-19 or as a close household contact. That doesn't take into account all the people that have the flu, and it doesn't take into account anyone, I think the 2 people so far that we've identified with monkeypox. So there are, these are big limitations. You go and find me a business who can operate with that many people away each day. Talking to a major manufacturer up in the Hut a few weeks back, they were saying their firm of 40 regularly had 10 people each and every day out. They can't fill orders. They are having huge backlogs coming through. It's concerning because everyone's used up their sick leave. So there are huge pressures. As much as we talk about, the economy and trying to keep things going, the economy is real people. And man, if you haven't got someone on the floor doing the work, it's very, very hard to keep things moving. So that's a key limitation. It comes at a time when we're trying to do a lot, but realistically it's hard to resource. But as much as that's a problem, and trust me it is, I think it goes to one of the sort of underlying conversations for tonight, and that's that at the moment there's so much that New Zealand as an economy wants to do. It's not that we don't have stuff to do, it's we don't have the people or the materials to do it. Now that's a challenging position, but it's also a good position to be in. I'd rather that we had work to do and we're struggling desperately to find the workers to do it than to have nothing to do and everyone to be twiddling their thumbs. So this is a challenge, yep, but also a big opportunity. We know as well that finding people to do that work, even outside of sickness, is challenging. Now, there's always been difficulty sometimes recruiting new staff across the country. What we're seeing now, though, is that businesses are reporting that it is the most difficult time on record, going all the way back to the 1970s, to find workers. More importantly, there's the highest levels of job poaching that there's ever been. And that's quite different, right? Not only now do you have to go and try and reach out and grab a new person, you've now got to keep your hand very firmly on the people who are already in your office to make sure they don't leave. And that's different, again, coming at a time when there's a huge amount of work to be done, but we're struggling desperately to find people. There's a lot of competition, and it means that if you're looking for a job, one, it's probably the best time ever to ask for a pay rise. Don't tell the bosses that. But also there's an expectation there that people are looking to move around, they're looking for that opportunity. And so again, as much as there's a difficulty, there's also a real option there for people to think about how they get ahead. For young people, sometimes that's leaving overseas. Now, I flew back from Sydney yesterday, which was a minor miracle possibly for New Zealand to have a young person fly back into the country rather than fly out, because we know there's a huge amount of people who are leaving. Most of my friend group in Wellington have moved to London or Australia, and it is very much a real thing. Just to highlight this, over the last year there have been 15% more job ads listed across the country. If we wanted to, as a country, we would click our fingers and add an additional percentage point into employment. At the same time, the number of Kiwis aged 15 to 64 has decreased by 0.2%. The number of 20 to 29-year-olds has fallen by about 3%. So we are trying to do a lot more work. We're trying to fill a lot more roles with quite a limited amount of people, in fact, fewer people than we had before. That's an unusual position to be in, but it also means, again, people are having that war of talent. They're looking out for those opportunities. What it also shows is that when you have no people, and it's obviously very difficult to find them, and more of them are leaving, as a business you're starting to see people across the country start to invest in capital. They're looking for those new options for where they can bring in machinery, where they can still provide a return, they can still produce, but trying to get through the limitations that the labour market is producing. And just to reinforce what that means, and one of the reasons that people are looking for new capital opportunities is because at the moment to find a worker is difficult enough, to then pay them enough to actually attract them into your business is even harder. This chart here, there's a number of ways that economists talk about wage increases and similar. This is a very simple chart. You take the total wage bill for the economy, you divide it by the total number of people earning that wage, and you've got average wages or average earnings per worker. You'll see there that it has increased at its fastest pace to its highest level in 2 decades in recent times. So this is very much the pressure where, again, great if you're earning that wage. As a business though, you're going, man, how do I resource things? I'm struggling to make ends meet. I'm having huge cost pressures put on from wages and materials and electricity and petrol and similar. I've got to then charge that out. I'm having to pass on that cost, and you're starting to see that pressure coming forward. But with those very high costs, with it difficult to find people, again, you're finding business operators who are keen to invest. They're looking for a different opportunity so they can keep that momentum going in their company. They can sort of bring that return forward. All of that comes at a time when inflation is high. Now, the very, very simple one here is looking at the likes of petrol and similar, although I probably should have updated this chart because it's gone even higher since then. Around about $3.30 a litre nationally across the country for a litre of 91. Diesel, though, sometimes is worse, above $3 a litre, which is pretty insane to see. Again, this is where, you know, the rubber hits the road. I'll show you some inflation charts in a moment, but you will all see this each and every day when you go out to fill up, unless you're one of those smart people who got an EV ahead of time. If so, let me know. I'd love to have a ride and see how good they are. But with that, we do see some huge challenges around inflation. Now, that's bad for us, right, when we're driving around. Even harder is when all of our goods that have to move out and about are also costing a lot more because diesel's more expensive. It costs a lot more to move the tomatoes into the supermarket. It costs a lot more for the limited amount of jib to be moved around the country to the right, building site. So this is a real pressure. Now, we can't do a lot about this. As much as we've tried, Vladimir Putin is not picking up the phone at the moment. He's not keen to engage. He's pretty hell-bent on war and destruction. So we can't do a huge amount about that. What we also know, though, looking through the numbers, is that about half of inflation in New Zealand is overseas based. Again, we don't have a lot of control over the likes of petrol, we don't have a lot of control over the likes of inflation, but we do have control about just how much stimulus is going into the economy, because at the moment, very simply, we are trying to do too much with too little resource, and that is contributing to price rises. I think Scott was talking before about how he's doing some renovations at home. It's the same renovation at the end of the day that he's going to be paying 20% more for. The same fittings and fixings that he would usually have used, but paying a lot more, and that's because of just how much competition there is in the market. Now, we continue to upgrade our expectations of inflation. In fact, we're sort of getting sick of getting it so wrong that we have to draw a whole nother line. What's interesting at the moment is that we have started to moderate those expectations. We feel like maybe we're at a peak. That's the good news. The bad news is that maybe it's the peak, but maybe it lasts for longer. And in my mind, what you're seeing there is that if you give inflation an inch, it will take a mile. And that's because by the time you see inflation, it's very much started to bed in. By the time everyone looks out there and sees that everything is so much more expensive, they want to get out there and buy as many goods as possible before it gets even worse. And so there's a self-fulfilling prophecy with how bad inflation can get. Now, as bad as that chart might look, it's always scary as an economist when the Treasury reckons that it's even worse. These are the government's own economic advisors who say that it's still going to take until 2025 for inflation to get back under control, to get back towards where the Reserve Bank tries to focus, that 1 to 3% band. And the reason I highlight that is because this is where it's going to become difficult to keep those earnings and those returns high, because inflation is the thief that is stealing money quite literally from your wallet. And because of that, it means that they're looking at where you make your money and how you get those returns is not nearly as simple as it has been over the last few years. Quite honestly, in 2021 and 2020, there were a lot of times where you could put your money just about anywhere. You could leave it on the front doorstep and it would be making more than you could otherwise find. So that was easy money. That was where there were a huge amount going forward and you didn't have to work particularly hard. Now things are very much turning around. One of the reasons, of course, is the global supply chains that we see. And I just want to highlight this for 2 reasons. One, because there's some good news here. Freight prices are only 5 times more expensive than they were previously. I'll take that when it used to be 7 or 8. But also, we're 2.5 years into this pandemic now. We've had more ships going across the water, but we still see these sort of disruptions. We still see the sort of price hikes. Now that says as a country, New Zealand's going to have to do something differently when it comes to our supply chains. We know that because of the amount of disruption that people are starting to do it alone. Because of the Russian invasion of Ukraine, there's not a lot of sunflower oil. 75% of the world's sunflower oil, which goes into all of our lovely baked goods and similar, comes out of the Eastern European area. It's gone. One of the major providers of another food oil, palm oil, comes out of Indonesia. They had a look at the price recently, said, hey, that's a bit too much domestically. I think we'll ban all the exports so we can keep it for ourselves. Malaysia, about a month ago, said, hey, we're one of the major exporters of chicken in the world, but it's become too expensive locally, so we'll ban exports of that. If everyone's starting to ban everything they're doing locally, that suggests that New Zealand is going to have to be worried about that risk of globalisation and not being able to get stuff. That means we need to have a much stronger supply chain located here domestically and provide some real opportunities for those who are developing those more solid, more domestic supply chain options. Now, you heard earlier about the increase of the official cash rate. That was most of my afternoon spent digging through and reading every single word that the Reserve Bank put out in its one-page statement. It has increased as expected by another 50 basis points. The Reserve Bank is working hard to try and get inflation under control. But they started behind the 8 ball, and sort of like the All Blacks, they haven't been able to make up time just yet. In fact, there's still quite a lot of challenges. I am hopeful, however, that we will make the right decisions when it comes to the weekend's test. Now with that, you'll see here that there's still a way to go. The interest rate that the Reserve Bank's currently got on the official cash rate, 2.5%. They reckon it might well need to go to 4%. So we're just over halfway there. And there's an expectation again, as those interest rates rise from the Reserve Bank, that puts a huge amount of pressure on a lot of other earning potential. You look at the likes of the NZX 50. Who have taken quite a dip. In fact, I'd like to show you my KiwiSaver balance, but I'm a little bit embarrassed by it, so we're going to keep that well in the pocket. But to make the point that people are thinking about and having to invest in different ways. Now, I remember quite clearly at the start of COVID-19 when we hit the dip and everything looked awful, fielding many calls from friends saying, hey, how quickly can I get out of this KiwiSaver thing because I'm losing money? And a lot of the time it took a lot of nerve to be able to keep your money in there, but people had investment strategies. I certainly had one, and my thought was that I wanted to have that in my KiwiSaver for the long term. I knew that there would be market ructions, but I knew also what I was looking for over the longer term. So yes, there are some big changes. Now, would you invest in that at the moment? Are you making a good return? Absolutely not. There are some huge difficulties there. Housing? Well, that's even worse. And let me tell you, as someone who would like to at one point be a homeowner, this is quite a big shift. And again, comes at a time when people are looking for opportunities, are looking at where they're parking their money, and it's difficult. Scott outlined the likes of term deposits before, giving you a negative return when it comes to inflation. Houses are now worth less than they were almost a year ago. The NZX 50 is also doing the same thing. So at the moment, it's difficult to find a good return out there, but people are looking at different options increasingly. Just to put the housing one in perspective though, house prices, even at their lowest point that Treasury expects they might get by September 2023, will still be 32% higher than their pre-pandemic levels. So yep, there's a bit of a pullback, but it's after a pretty massive increase over the last few years where people have been really giddy when it comes to where housing outcomes have been. So a feeling that for as much doom and gloom as we talk about the housing market going down, the fact that it went down by less than a percentage point this month after going up by about 40 over a year or so, just a little bit of perspective there in terms of expectations. What it also profile though is that again, that ability to make money and have those stronger returns over time is becoming more difficult. You look at a chart here, and this is a little bit complex, give me a second to explain it. What you see here is the average repayment as a proportion of someone's income if they bought a house at different periods of time. So if you bought back in 1949, your total repayment on a house over the lifetime of your 25-year loan or so was only around about sort of 6-7% of your total income over the period. If you bought today, you're paying around about 33% of your income on average over the lifetime of it. So at the moment, again, becomes harder to make some of those returns worthwhile and some huge difficulties when people look at where they're putting their money. And just to finally reinforce that and highlight some of the opportunities that are coming forward, we see a big shift in where people are putting their cash and where the investments from businesses are turning towards. Now, I talked before about the likes of the supply chains and how New Zealand is having to do that a lot more domestically, how there's a huge focus on the likes of freight and logistics, an increasing focus on manufacturing, particularly advanced manufacturing. You can see that. At the moment, there's been an increase in the amount of commercial consents for the likes of education. That's good. I'd like young people to be smart when they grow up, so that's a good starting sign. Increasingly, though, and after quite a bit of retrenchment, we're seeing a lot of factories being built across the country. People are wanting to secure their supply chains. They're wanting to make sure they have that focus on what they're able to produce. We've seen an increase in hospitals as well, always encouraging during a pandemic to see that we're doing that. Hopefully we start to pay the nurses more so that we can staff the hospitals as well. But the third bit there, and the next one, is warehouses. And just to highlight again, that focus on people wanting to make sure they have the ability to bring in product, to manufacture and construct product, and then have somewhere to move it about. Our logistics and supply chains are some of the most important things that New Zealand has, and increasingly an area where people are looking to invest more because they can see not only the opportunity that arises from it, but also the challenges of international supply chains and how important it is to have that local and to be able to protect ourselves as we move forward. Now, with all of that and a huge amount of information that I've just presented, just some key messages if I can. The first one is that it is going to be more difficult and more expensive to grow in 2022. That is relative. We're coming off the boil at a time when the economy is trying to do too much with too little. There's worries about a recession. There's worries that fall in consumer confidence is going to turn the economy into a much slower position. Realistically, though, we know we're trying to do too much. We're trying to bring the economy from a rolling boil down to a simmer. You don't want it to go lower than that, but we do have to lower the temperature a bit because at the moment we're seeing too many things spin out and not be able to maintain the same level of momentum. There are opportunities out there. For as many challenges as we can outline, there's also a silver lining on the other side of the coin. People are looking at where they can make a return. They're looking at options that are not currently providing and saying, actually, I need to be thinking about something different. So there are opportunities out there for people who are willing to look for them, but very much so there's not the easy sort of opportunities that have been there over the last few years. There is an ability to grow. The New Zealand economy has a good level of starting momentum, but we are going to have to work very hard for our returns over the next few years. With that, I'll leave it there with a bit of doom and gloom and take your questions if anyone has one to start, and then I'll turn over to the much more exciting part of the evening, which is, okay, Brad, you've just said that returns are really bad. Where's another opportunity perhaps to think about parking your money? So, try to take questions unless I've depressed everyone in the room too much. No one's thrown anything, which is a good start. If you do have a question, raise your hand and I'll point. Complete silence. I've scared everyone into it.
Brad, just in terms of relativity, New Zealand Inc. versus perhaps some of the other competing nations, where are we in the glass?
Well, the fact is that the economy in New Zealand is still about 3.3% bigger than it was at the start of COVID-19. That same can't be said quite as much for other countries. We've made back the amount of activity that we lost during the lockdowns and similar in recent times. I mean, we're pretty similar to Australia. Both our two countries are sort of motoring on, but relative to the likes of the UK, the US, even parts of Europe, we've got that ability where we've had enough momentum, we've got people who are still spending, but importantly, as much as inflation is a challenge here in New Zealand, at 6.9%, it's not quite as bad as the 10% they're seeing in Europe because they're paying 600% more for natural gas. It's not as bad as the 8.6% they're seeing in the US, which is the worst inflation in 40 years. So, yep, we've got challenges, but you're right in terms of actually at the moment the New Zealand economy is well positioned. We're doing a lot better than a number of our peers. We've got a lot of work to do to keep up that momentum, but the fact that we're sort of so far in front of the starting line compared to a lot of other people means that we're able to keep that momentum going. We're able to figure out new ways of engaging the economic motor.
Brad, I've got a question as well. I'm just interested, I don't want to make this about politics at all, but interested in the consumer sentiment piece, that graph you started on, what your views might be if we see a shift from red to blue next year in terms of that sentiment shift.
Yep, I mean, certainly if we were looking at business confidence, it would shift quite a lot. There's a lot of politics within business sentiment in terms of headline stuff. Realistically, we know, though, that the same challenges that we're currently seeing aren't going to be magically solved overnight, no matter who is necessarily in power. I say that because, again, we can't just click our fingers and magic up more GIB or more people. What I think you could see over time, though, is a bit of a change, and this is possibly true of both political parties in terms of some of those pressures, right? We're talking a lot about immigration at the moment and how difficult it is to try and find skilled workers. I was in the room last week with the Australian Treasurer and the New Zealand Finance Minister, and they were talking great talk, and it was great talk about getting more New Zealanders into work. And that's good in 3 to 5 years' time. But in the here and now, when we know that we want workers, I asked them, what are you going to do in the next 5 weeks or so? So I think there's some big changes from an immigration point of view to be able to bring in the right skilled labour that we need, at the same time as building up the capacity of local Kiwis to get into that work in a few years when we've got them with the right skills. Realistically, though, despite any changes of government that may or may not occur, those issues around inflation are still going to be there. And certainly from a consumer confidence point of view, the Reserve Bank is independent. It will be raising interest rates no matter who sits in the ninth floor of the beehive. That's cold comfort, of course, for people who have got mortgages, but realistically, again, trying to get inflation under control remains the key topic of conversation. And the unfortunate idea there is that if we're doing this much work and we've only got that much resource, well, we can't magic that bottom line up. We're going to have to drag something down, and that means that mortgages have got to increase so that people have got less to spend on other areas. Yes. Someone's jumped in.
With the amount of money that the government has borrowed to keep the economy going, shall I say, do you see that the economy is buoyant enough that we are not, as a generation, leaving our kids, etc., a huge debt to pay off in the future? Or where do you see this going?
Yeah, well, I mean, short answer is yeah, we probably are leaving the next generation. And I say that as someone of maybe not the next generation, but sort of on the cusp, shall we say. That is being left over. We've put a huge amount of money on the credit card. Now, at the start of COVID, I completely agree with that. We knew that we had to keep the economic momentum going because otherwise we would have left the next generation with a sort of burning crater. That was less appealing. The question I think we've got to ask now is that if we keep saying that we don't have enough people and enough resources to do more, why are we trying to chuck even more into the bucket? And I think that's the point at the moment that, okay, we've sort of gone to the hilt. We're doing as much as we quite physically, literally can. We haven't got more people to do work. We haven't got more cash to do work. We haven't got more materials to do work. So we need to pull back at that time, I think. And the key point here, right, is that at a time when the economy was hit hard, we pulled out the stops, we borrowed, we made sure that we dragged interest rates down, we supported as much as we could of the economy. At a time when we know that the economy hasn't got a lot more to give, why are we still putting the Bunsen burner under it and trying to cook it even more? It's a piece of well-cooked steak. It's done. You can't do much more to it until you turn into charcoal. So I think there's a conversation that we need to have of, that was important to start with, but when times change, when the activity in the economy changes, we've got to be quick enough to do it at the same time. If we're quick to cut on the down, we've got to be quick to raise on the up, because at the moment we are very much trying to overdo it, and that is leaving future generations with a lot of debt that we haven't got a lot to show for it, right? If we were using that debt to build stuff and we were constructing a huge amount of assets, I don't mind that. But at the moment we're paying more for the exact same asset we might have got a year or so ago because we're trying to do too much all at once. So I think we've got to be realistic about where we're putting that cash.
So, one way out is productivity growth. What are you seeing in terms of capital investment?
Well, it's difficult when interest rates go up as part of it. I think the other bit, though, is in general across the economy, there's a huge amount of uncertainty. Economists keep talking about recession. We know there's risks around the likes of Chinese economic growth. We know that the Russian invasion of Europe and Europe rather has caused some huge difficulty. So it's difficult at the moment to see a huge amount coming through there. What I think you are seeing is that more people are at least willing to think about capital investment simply because they've got to at the moment. Because you don't want to, and you probably just simply can't afford to be paying more and more labour, the amount of money that they're being asked to, without at least considering the option of investing in some new plant and equipment. So it's starting to come through. It's always a slow burn in terms of that additional investment. What we're also seeing, though, and what does encourage me, is that we're starting to think much harder about the education that we're providing to people, making sure that as the world changes, what we provide to young Kiwis is also changing. We're upskilling and thinking about different ways of operating. The fact that, when I went to university, we still didn't use a computer, and that was quite literally 7 years ago. The fact that we do now, again, is more encouraging. So we're starting to get better both in terms of physical assets, your big machinery across the primary sector, across a number of areas, but we're also thinking about those intangibles. How do we upskill people? How do we give them the right technology as well so that we are working as smarter, not harder as we can? So it's a slow burn. It's a difficult one to get over quite quickly. We've had a productivity deficit for a number of years, but I do think we're starting to turn the dial and get into a better position. One last question and then...
Just ask how we're measuring that increase in productivity, because we actually are not overly literate in what technology can do for us to increase that productivity. So it's really important that we actually lift that first so that we can then increase the productivity. What's happening in that area?
Like I say, it's a slow burn. I'm not going to say we've solved that by any stretch of the imagination. The fact that a young person coming out of school at the moment can do less maths than they could a few years back is hugely concerning. So we've got some quite a lot of ground to build up. I think what's encouraging is that we've actually recognised now that point, right, that we need to have that technological gain. If you send a young person out into the economy who hasn't learnt how to use a computer and hasn't done things online, they're on a bit of a hiding to nothing when it comes to competing with someone who's coming out of Korea, coming out of the US, coming out of the UK. So we're recognising it. We're not there yet, but I think increasingly, certainly talking to schools and similar, we're starting to provide those sort of digital outcomes. We've got more investment going into actual physical resources. Very hard to learn how to use a computer if your school doesn't have one and similar. So we're starting to get there in terms of the resourcing.
It's also, though, learning to use robotics so that we're not requiring the resource that we're using now. So it's actually getting machines to do the work, so that we're not requiring that level of physical resource. It's happening worldwide, and we seem to be behind the boards.
Yep, we are taking a while. I think as well, part of the difficulty for New Zealand is that we do things in a slightly different way. We're not a massive manufacturer. We do a lot of it, but we're also, we're not a Japan in terms of making cars and similar. What is interesting, and just that point to extrapolate, and then I'll hand it over to Matt. The point where, and one thing that we're seeing at the moment is in the primary sector. People are starting to buy some bigger kit, so instead of having to have everyone hand pick the apples or whatever it might be, you do send a machine across to pick and thin and prune and similar. What we're also seeing though, and I think has a big advantage for New Zealand, is that increasingly we know that people are buying services. They're buying intangible things. They're buying your Xero softwares or a game from the Apple App Store or similar. So increasingly more people are getting into that area. One of my good friends who runs Girl Boss is working increasingly in that area to make sure that when young people are starting to come to the end of their schooling career, they not only have the skills to do it, but actually they know that there's a pathway for them to go down. You can teach as many people as possible about how to use the technical bits and pieces, but if they don't know where that career might lead them, then they're going to go down their normal traditional pathways. And so I think there's a lot of opportunity there for New Zealand to actually redirect people and say, look, yep, these are the jobs that we had previously, but there's a whole new set that are coming forward that we need to be directing people into. So a lot of opportunity, and I guess grateful in a sense that we'll end on something that, yep, there's a challenge there, but there's a huge amount of options for New Zealand looking forward, because trust me, most of the rooms I go into, it's fairly doom and gloom at the end of a presentation, so I'm happy we might well end on a bit more of an upbeat point. With that, I'll hand over to Matt to run you through what's happening with the offer and outline some of those big opportunities that are coming forward.
Thank you, Brad. A lot of information, elegantly presented and efficiently presented too. I realise I'm standing between you and another drink, so I'll try and keep this brief and to the point. I'm going to talk about the upcoming Pacific Property Fund offer. Many of you in the room will be existing PMG investors and existing Pacific Property Fund investors, but there will be some who are not. It's important for us all to be aware of both existing and prospective clients because it also impacts us to a degree as existing clients as well, and helps you to, I think, believe or see that we are executing on said strategy for the fund. You never know who's in the room from the FMA, so we will run through the disclaimer. The offer is not currently open or live. We're seeking preliminary indications of interest, so technically we call that sort of a book build. They're non-binding. At some stage in the not-too-distant future, late July, I'll work through that shortly, we will have a product disclosure statement, a PDS, which we'll make available upon request and free of charge. Myself and my team will not provide personalised investment advice. We are well educated and knowledgeable on the market and what we do, which we can share that information with you, but we won't consider your own personal circumstances when we do so. If you're interested in seeking somebody out that can provide that service. Locally here we've got a number of names of people and organisations that we would recommend. Just a reminder of the strategy for Pacific Property Fund. So this fund was launched in 2014 with the acquisition of the Tui Garden Products building in Truman Lane. Many of you will know that business or buy their products and understand just how successful they have been. Over 100 years old and a fantastic business still growing today. Wind the clock forward, we're now 20 odd properties across the portfolio, over $400 million of asset value. And the strategy has always been one around how can we reduce risk for clients and investors in this fund. So we came through the global financial crisis and we saw a number of headwinds for the standalone syndication structures and decided that we were going to sort of reinvent that wheel, so to speak, and that we wanted one structure with multiple assets within it so that we weren't beholden to any one location, property type or tenant industry. And we're certainly achieving that goal today. That helps to ensure our returns are sustainable fundamentally, because if Scott likes to say, as the economic storm clouds might roll over the Kaimais, we've got a fund and a structure there whereby if we lost 1 or 2 or 5 tenants, should not have an overly material impact on our ability to continue to pay returns, versus a standalone structure, or if you owned your own building, for example, where you maybe a hospitality tenant at the moment, or strip retail is a good example, where it's really, really tough in those environments right now. If you lost that tenant, you'd lose all your income and a significant amount of your value along the way as well. And that helps to provide growth and value for investors over time as well. A lot of commercial real estate value is underpinned by its rental income, its rental flow, and to lose the rental income is to lose value. To retain it and grow it over time is to increase value. And the structure of the fund allowing investors to we've really democratised this space. We've broken down the parcels from under the syndication model, which might have been 100 grand, 250 grand, 500 grand. There's stuff in the last few years that started at $1 million. Now, so your client base is much, much smaller when you're starting at that sort of price level. For Pacific Property Fund, we start at 20,000 shares and then multiples of 10,000 shares thereafter. I'll disclose the updated share price shortly. But that means it's now accessible for far more humans than what it used to be. And that allows us now to have a deep database, an active database, which helps to facilitate on our matching service investors in and out if and so they choose. And we're normally able to provide liquidity within a 4-week window for our average size investment parcels, which is about $250,000. Just the portfolio and its performance. This is only a snapshot, what we'll call the sexiest assets in the portfolio, if you can call commercial real estate that at all. But this is essentially a snapshot, 6 across the country, 20 properties, 99% occupancy, 437 mil of value in 5.6 years. I often compare this to listed property vehicles because could be a bit of a misconception in the market that unlisted vehicles or syndicates don't always perform or have the same quality around their headline investment metrics as what you might see in LPVs. But this rivals a lot of listed property vehicles, if not exceeds some of their performance as well. So that's a myth debunked in my view. In the last 5 years, very pleased to say that we've managed to achieve an 11.81% total investor return across Pacific Property Fund. So we talk about cash returns out of this Pacific Property Fund, and we talk about cash returns from other asset classes, cash in the bank, term deposits, etc. So even on a cash basis at the moment, we'll be presenting this to you at a 5.3% cash yield. For the quick mathematicians in the room, you'll know inflation at 7.5%, that's still under zero in real terms. However, the benefit of commercial real estate is the growth in value over time, and you account for that as well. It's very much inflationary protective and ensures that our money is not going backwards long term. We do have a focus on the industrial sector. I think both Scott and Brad did a really good job of sort of quickly summarising some of the themes as to why our focus is in that space. The industrial sector is, in our view, quite defensive assets during inflationary periods. There's strong businesses. There's a real lack of supply in the market at the moment around quality industrial. Vacancies are being held at all-time lows, and it's allowing landlords to really negotiate strong rental growth, and that is adding value. And that's one quick way to sort of summarise how we're protecting the value of capital. We are increasing our exposure to the warehouse and logistics centres, and just jumping down to the last point, in a sort of pandemic and post-pandemic world, the just-in-time inventory model doesn't really work all that well anymore. Big companies or any sort of business might have just, within a week, they got product coming in and going out the door. That doesn't work with supply chain disruption like what we've seen. So warehouse and logistics businesses now want more space. They're ordering larger quantities, waiting longer for it, but they need to stockpile to a degree before they can get it out the door. And we're not seeing those sort of themes dissipate at any time soon. So add to that the cost of actually constructing new industrial buildings to soak up the demand that we're seeing in the market for them. The cost is simply too high. So labour costs and constraints, materials, can't get them here, when, if, too expensive. So it's putting a lot of pressure on quality industrial stock around the country, but in the core major metros as well, in what we refer to as the golden diamond, which includes Whangarei. And that puts pressure on rents and values over time too. And it's been a standout performer in the last couple of years as a result, alongside large format retail, believe it or not. So things like supermarkets, Mitre 10 Megas, Bunnings and the likes. So we're really bullish on the industrial sector with a long-term view. And there's always been strong thematics around investing in the sector, notwithstanding the fact it's much easier to manage than big office buildings and large format retail centres as well. And so we continue to be attracted to that space. I want to talk briefly about the target acquisition properties. So this is in part the Keith Andrew Trucks portfolio. So it's 3 out of their portfolio. For those of you that are familiar with the Keith Andrews Trucks business, Keith Andrew actually unfortunately passed away a few years ago. His son Curtis is now managing director of the business. These guys are large. They turn over about $280 million in revenue every year and sell over 1,200 trucks. Since sitting down with Curtis last week and getting the skinny on his business and how it's grown since 1991, it's amazing. You can't go anywhere now, well I can't, without seeing a Fuso, a Mercedes-Benz or a Freightliner truck and pointing it out to anybody that's around me. So I've now got a newfound passion for trucks, believe it or not, no idea how to drive them. But these portfolios, this portfolio is 1 in Te Rapa, Hamilton and 2 in Whangarei. As I said, they're distributors for Fuso, Mercedes-Benz and Freightliners. They have 25% of the market share in New Zealand for new truck sales, and about 80% of that is the North Island, 20% in the South. These guys have a real passion for what they do. They have a commitment to sustainability fleets. They're actually the first in New Zealand at the moment. They've got a short distance truck. It's a Mitsubishi Fuso truck that can go about 140 k's before it's got to turn around and recharge. It takes 40 minutes to do that at the moment. The technology is improving all the time, but effectively what those trucks have been used for is the NZ couriers of the world based in Auckland, short distance couriers and freighting options, etc. And that's only going to grow over time as that sort of theme continues as well. We are able to say as well that the Andrews family, or Curtis and his family, was so, I suppose, encouraged and enthusiastic about what we're doing here that they are going to be leaving a substantial sum of the sale proceeds in the Pacific Property Fund as well. And that's really, really pleasing. I think a strong nod to our acquisitions team and the work they do, our investment committee, our board, and the whole PMG business, that somebody like this believes that we're doing the right thing and they're prepared to leave a substantial sum in on a long-term basis in this fund too. So I'm going to play you a quick video as to what the fund is sort of going to look like.
Pacific Property Fund Limited is one of the largest and most diversified property funds available directly to New Zealand investors. In the last 5 years, it has provided investors with an average annualised gross cash return of 6.77% and a total return of 11.81% following increases in the value of the fund's underlying assets. While it might feel like the world's been turned on its head these last few years, the industrial property sector has continued to thrive. This is why we're now looking to strengthen the fund's portfolio with the addition of 3 quality industrial properties. These will increase the number of properties in the fund's portfolio to 23 and raise its industrial weighting to 68%, better positioning the fund to provide reliable, sustainable returns to support investors' lifestyles and access to long-term growth. At PMG, we have helped generations of investors during changing economic cycles. Talk to us today about how you can take advantage of a limited investment offer to join or increase your investment in our flagship fund.
We're getting pretty good at these things. I'm going to be done out of a job in the next few years. Just to reiterate some of those key points, the fund will be 23 properties, predominantly in the what we refer to as the Golden Triangle, so it's Whangarei, Auckland, Hamilton and Tauranga. $471 million of portfolio value. This will become very close to, if not the largest directly owned unlisted commercial real estate fund in New Zealand available to retail investment clients. Scott mentioned earlier the differences between a wholesale investment offer and a retail one. Retail offer, it doesn't mean it owns retail property, it means it's open to every single person able to meet the minimum investment criteria. And it does also mean that we've worked through and demonstrated to the FMA that we've effectively provided all of the information that they deem necessary for everyday investors to make a fully informed investment decision. And there are certain protections afforded to investors in those schemes versus wholesale ones as well. 99% tenant occupancy maintained. That's a testament to the type of real estate we own in this fund, type of businesses that we attract. 68% industrial weighting, so that's lifting by about 3 or 4% through these acquisitions as well. We think that's a prudent strategy to lift the industrial weighting in light of the environment that we're within now and will be in the future. And pleasingly, the weighted average lease term is lifting to 6.1 years as well. That's really a reflection of the term certain income you can expect to generate as an investor in this fund. Just want to point out after offer and before offer metrics. So essentially gross rental income by region. All we're demonstrating here is that we're reducing reliance on a key region being Christchurch and Wellington and other areas, and just geographically diversifying our exposure further. Again, not beholden to any one location. By sector, we're increasing exposure to the industrial space by a couple of percent, not a major change there. And then this is sort of a characterisation of the weighted average lease term metric that I mentioned. So all we're showing there is that after the offer is complete, the orange bar shows you that more of our income is out extended for a longer period of time. So that's reflected in your weighted average lease term metric, which is important because, as I said, that gives you an idea of how long can I rely on that income at that level for across the tenants on a weighted basis. And the last one's just demonstrating that we're reducing reliance on any given tenant within the business as well. So reducing how much any individual tenant provides us as a fund. Key detail about the offer, up to 64.4 million shares available. A minimum initial investment for 20,000 shares and 10,000 thereafter, unless you're an existing PPF investor and you can then buy already in further multiples of 10,000 shares. For the astute eye in the room, you'll notice quite a lift in the share value. That's reflective of a lot of hard work by our property management team to add more income and more value to these assets. It's also reflective, of course, that the market's been reasonably kind to us over the last 12 months. That share price lifting by 10 cents per share from what it is currently. And that will ensure we're going to be able to retain a 7 cents per share distribution, so there's no change to the distribution rate. But on the new share price, that will be reflected as a 5.3% cash yield. Now, that's after fees and expenses, gross only of tax. The taxation benefits we get through the PI regime under these funds are beneficial for anyone that's paying tax at 30% or higher, because under the PI regime it's capped at 28%. And there are also other benefits around non-taxable income components of our returns to investors as well. So all of the existing investors in the room will have seen when you get your distribution statement, there is a line there that says taxable, that's the amount you pay tax on. There's a line that says non-taxable, that's the amount you pay no tax on. It's all legit, above board, but you'll often find that the non-taxable amount is quite a substantial sum as a percentage of your overall return. We can go into the detail behind that after a beer afterwards. It gets a bit complicated, but all you need to know is it's much better for you. And we are, for many in the room, this is going to be a big hip hooray, moving to monthly. We've been quarterly returns since inception. Yes, and it's been a lot of clients been requesting whether or not we could move to monthly. We're now pleased to report that we will be. So I used to say with PPF it was water and bread for a few months, and then you can have your wine and biscuits. Now you can have your wine and biscuits more frequently, which is good. Yeah. Or you come to these events to drink for free, eh, Anthony? Offer closes 26th of August. We intend on lodging the PDS around the 22nd of July. There'll be a bit of a cooling off period before we can accept applications, and we will be closing around that date. Just to reiterate, the last couple of capital raises for Pacific Property Fund were fully subscribed ahead of schedule. No lies, it did happen. We had a lot of interested investors who did miss out. Might have been they delayed in touching base or what have you. If you are on the book build and express your interest, there is a higher degree of certainty you will get your allocation. If you're not, basically what we do is if you express your interest, you fall into the book build, we will work with you first. Once we've converted everybody on that book build, if there's anything left over, we'll go to new clients. Okay, so if you're on there and you want to put your hand up, please reach out to any one of my team. And just to finish up, before we might take up the questions, this will work from the back of the room. If you want to express interest, you can get your phone out. We're all familiar with QR codes after a couple of years in the pandemic. It'll work from anywhere. It'll link you through to a specific page, and you can put your details in there as well. And I think there's also feedback forms on your seats, which has the same QR code. If you've already registered your interest, you don't need to do that again if it's already been done, but feel free to check that's been the case.
Thank you, Matt. Appreciate that. Just like to again acknowledge Brad Olsen for the good words you spoke there. Really appreciate your insights. Brad, he's on the road with me again tomorrow. We'll be up in Auckland doing the same sort of a presentation, and great to see such engagement, good questions around the crowd. So maybe, ladies and gentlemen, just a little acknowledgement again, Brad Olsen. As Matt talked about, I would encourage you to put your hand up if you think this is something you want to participate in. Again, that same message that we want to leave you. It's very much a long-term view. If you do feel like value is going to go off the boil in the next 6 to 12 months, this is not for you. This is a long-term investment strategy, and you should treat it as such. So we encourage you to put your hand up. We know that Matt's got a large book build commitment there at the moment, so if you want to get involved, please do so. Ladies and gentlemen, thanks for your attendance, really appreciate it. Great to see a fantastic crowd along. Always nice to be presenting in Tauranga, and good to see our loyal customer base continuing to grow. We really do appreciate your custom. Please join us, have a drink with us, have a chat with the team out the back there, and do have a very safe journey home. Thank you very much.